Right, good afternoon, early evening. Thank you so much for joining us to be here for our Budget and Beyond event, just to understand a little bit about good old Rachel's changes that she's put into place. For those of you who don't know me, I'm Emma White. I'm one of the managing partners at A4G, and I've been there since I was 18, so I won't quite tell you how long that is, but anyone that guesses too high might be in trouble later. The things we're going to cover tonight is the 2025 year in review. Then we're going to look at the budget update. We're going to look at the impact that some of the changes that have come out in the last sort of year or so are actually having on the way people are structuring their businesses. And then we're going to have a look at making tax digital. So A4G, it's our 30th year this year, which is why we thought we'd do a bit of a later evening with a few drinks and nibbles. So it's been quite a transitional year for us this year. So Josh and I in March took over from Malcolm Palmer, who was the founding partner. I've been there since I was 18, and Josh joined us as a university graduate, studying history. So, but we've also had 2 new partners appointed this year, both school leaver trainees at A4G, so we're very proud of that. And we've taken on 5 trainees as school leavers this year, which is always a bit of a process, you know, sort of teaching them not to doze off at 3:30 when the school bell normally goes. But it's really fundamental in our growth, and we're incredibly proud of the fact that we do like to recruit and train from 18. Now, I don't know how many of you might know, but there's a lot of venture capital invading the accountancy market. So one of the things we want to assure you is that actually we're not going anywhere. We've kind of stuck our flag in the ground, and we are vowing to be, you know, completely independently owned, because we believe that means we are putting service above profits, and that is often where venture capital investment goes wrong. Yeah. So I think that's good to know, and the advantage for that for us is actually we're being approached by other accountants, like-minded accountants, who are looking to retire but want to find good homes for their clients and aren't prepared to sort of sell out to venture capitalists. So we have done an acquisition this year and picked up some really lovely clients, and it's allowing our team of partners to grow and provide sort of a bigger range of services. So if you do happen to know anyone that is looking for a replacement accountant because they're not getting the service they should be, please do point them in our direction. Our partners will be very happy. So what are the common questions we've been asked in 2025? We've been asked a lot about wealth and inheritance tax planning, particularly around some of the structures, so property, portfolios, looking at family investment LLPs, and company structures, bringing in children and passing wealth down the generation without incurring exit taxes. We've also seen quite a lot of businesses focus on their end goal. And that might be exit to a third party or management buyouts, but we're certainly seeing businesses, I think, really mean business now. Because I think it costs a lot on what do they do and what's their life plan with it. And new startup structures. So we're going to cover some of that. But often we're seeing businesses, they're setting up sort of new ventures and sort of what we call side hustles. So it's understanding how to structure that in the right way. And then one of the biggest things we get asked, and quite often why we like the networking part at the end, is we're asked about how other clients are getting on, how they're finding the market, what are the things that they're struggling with, or the challenges that they're facing. So do stick around at the end and network, because it's really good to understand sort of the economy of small businesses. So what's been the big changes? I think our feeling is always that small businesses are continuing to be squeezed, certainly over the past year. For any of you that came to the seminar when we were having 10% inflation and the corporation tax rate jumped, you may remember the very scary number I quoted at that time, where we'd worked backwards, that for businesses to stand still, you needed to have grown your turnover by 24% in 1 year. And I think that just goes to show how challenging it is in the SME market, where you are having to try and have those conversations with customers. And also the rise in sort of national insurance costs and minimum wage. It just means that any sort of repricing for a lot of businesses is forming quite a big discussion on contracts. So inflation is remaining high at sort of 5%. We're hoping to see that come down. And we are seeing sort of capital investment and expansion starting to slow down a bit. And I think we are getting to the stage, we see that before every budget, don't we, where people are a little bit nervous about spending money. So what do we think the economic outlook looks like? We're hoping inflation will fall a bit. I think the expectation is that the Bank of England said that they're aiming for the interest rate to hopefully drop to about 3%, but the historic average is 5%. So even at 4% currently, it is on the lower side. We're also seeing, and we've got some finance brokers, specialist finance brokers in the room, and I think the one thing that, the actual really good bit of news that they can give you is that lenders are becoming a lot more inventive about the way they are lending to business. So it's not just your traditional loan, there are some really flexible facilities out there to bridge gaps and growth, which is really useful for businesses. So I'm going to hand over to Josh for the budget bit.
Okay. Thank you. Right, really exciting bit. So the first thing I want to talk about is the hole in the public finances. 20 billion shortfall, apparently. I think we all agree that there is something to be paid for somewhere. There's a debate here. Now, before the budget, when I believe this 20 billion number, no matter where you read it, you could read different numbers, but let's go with 20 billion. So I thought, if it's 20 billion, what would I do if I were the Chancellor? Well, in 2023, they cut national insurance twice, and they said it cost £20 billion. We could, if they'd done that, this would be the end, and we could go and have some more drink and food. But obviously, politics gets in the way of doing something simple. All they'd need to do is put national insurance back to where it was pre-COVID, and that would be this 20 billion shortfall sorted. But in the end, because of politics, what we've ended up with is a budget that doesn't do anything big, but it's just full of lots of tinkering, which makes it a little bit complicated, and means it's very hard to weave a straight narrative through it and understand what's the big game here in terms of how it impacts small businesses. And ultimately, it was a budget that wasn't particularly SME friendly. It wasn't the worst budget for SMEs, but it still wasn't SME friendly. But it certainly wasn't a pro-investor budget, that's for sure. So there were some winners and some losers. Ultimately, I think anyone who runs a small business through a limited company was a loser, because the biggest headline for me was the dividends tax going up, which we'll come back to in a minute. And by implication, that means actually self-employed partnerships, LLPs, there were winners that didn't actually have any tax cut to those business structures, but compared to the company. So I always think, if you talk about gaming, they talk about nerfing and buffing. So if there's a character in a game that's slightly too powerful, they'll nerf it. They'll nerf like a Nerf gun with a spongy bullet, make it less effective. What they've done is they've nerfed limited companies, made them a bit spongy and less effective. Whilst because of doing that, it means that self-employed LLPs and partnerships, they've got a bit more muscle to that. That's what I look at anyway. It works in my head. Landlords, losers, because we've got a 2% increase in the income tax rate for rental properties. I feel that every budget, landlords lose something. It just seems to be, you just brace yourself to find out which one it is this time. But ultimately, all individuals, so every one of us in this room, are going to be a loser. And everyone in the entire country will ultimately be a loser when they pay tax, because of fiscal drag, which I understand the news outlets are starting to not like that word, but that's exactly what it is. I thought this was an interesting chart to share. Now, I have pinched this from the BBC, but this is showing each bit of the budget's tax raising and how much money it raises. And the thing that raises the most amount of money, up at the back you won't be able to read that, that's the freeze on the personal tax thresholds. That's 8 billion. Everything else sort of pales into insignificance really compared to that 8 billion. So the biggest thing is just doing nothing that raises the tax. And this sort of puts into context what we're doing, why it's tinkering. The other bit of context I always like to look at is the tax take. So this is how much the government has earned from the various taxes. And as you can see, income tax, massive, national insurance, pretty big. And this is why, because almost everyone who's working pays national insurance, you only need to add a tiny bit of percentage to national insurance and it creates a significant inflow of money to the government. Then if you add VAT, VAT is ultimately paid by the consumer. So it's the individuals who buy the end product in a business chain, usually, who pay the VAT. So all of this part of the pie is all paid by individuals. Corporation tax, pretty small, and then it all dwindles down into fiddly bits there. But that's the context of it. So when they're tinkering with these bits on the edges, you're tinkering with already small bits of the pie. But freezing the personal tax thresholds, that's this bit of the pie. So it's going to have a big impact, and that's why it creates that big income. So now, the thing that will affect most of our clients is the increase in dividends taxes. So I just want to briefly touch on the impact of this. So interestingly, they have increased by 2% the basic rate band of dividends tax and the higher rate, but they've left the additional rate alone. So it still remains just under 40%. I then did some maths and worked out, because the question that's been coming up many budgets in a row is, should I now pay myself as a full salary rather than a small salary and dividends like most limited companies do? Well, I can confirm that my math says a small salary and dividends is still the most effective way of getting the best net income personally. That sounds like a very complicated way of saying it, but I have to be very specific at how the maths works. So yeah, ultimately, small business owners take a small salary, the 1047 a month or whatever it is, and divide them with 12,500, and the rest of it is dividends. You're still going to be more efficient. The only exceptions are if you've got any reliefs that you might get for being a salaried director rather than taking it as your dividend holding. So R&D, I just want to say R&D, a lot of people say it's dead. It's not quite dead yet. So if you've still got the possibility of an R&D claim, then perhaps a salary might be a useful play. But my advice to limited company owners is this tax rise comes in from April next year. So if you're shy of 100,000 total taxable income, and you've got a bit of funds left in the company, it might be worth just topping up to 100k of income before the 5th of April 2026, just to top up to that band. Otherwise it'll cost you 2% to extract that money later on. The other question this then raises, and I sort of touched on it in Windows, is what's better, a self-employment or LLP or partnership versus a limited company? Most people, when they set up a business, and this year I've had quite a lot of startup businesses, which is always fantastic to hear, but all of them come to me already dead set, I've got to have a limited company. For a few of them, I've done a calculation and go, actually, if we look at this, how much would you earn if you were self-employed? And actually, if the plan in the initial years is to draw every penny out of that business, then self-employment is actually more tax efficient. So I've crunched the numbers very roughly. If you're looking at £100,000 is your personal income requirement, and your business is earning £137,000 or more, then a limited company will start to become more tax efficient. The reason why is because you're starting to generate more profit than you need to draw out. So retaining income in a limited company makes the limited company more tax efficient because you're only paying corporation tax on that profit, not your highest band of personal tax, which could be 60% if you're in that horrific fiddle band. But if you're below these numbers, an LLP, partnership, self-employment actually is more tax efficient. So for startup businesses where there's no employees, you might be just a consultant or a subcontractor. Actually, a self-employed route might be more tax is going to be more tax efficient. Sorry, you can always change your structure later on down the line. And this number basically suggests if you're retaining more than £7,000 of your profits every year, so you're not drawing it out for personal, then actually that's when a limited company starts to pay for itself. So limited company says you get that little bit more sophisticated, you've got a little bit of surplus to play with, that's when a limited company starts to work for you. Yeah, so drawing all your profits, consider self-employment is my general advice. There are a number of complications which I'm not going to run through because we'll be here forever, but I always think it's worth getting specific advice depending on what your plans are for your business as to what's the right structure for you. The other thing that was in the budget that I spent a lot of time thinking about, right, what does this mean, trying to grill what was actually being attacked, is the changes to salary sacrifice pensions. When I first read it, I thought, this doesn't mean that directors can no longer pay into their pensions. But I can confirm that no, that's not what this is attacking. If you're a limited company owner and you usually top up your pension each year, before the year end you go, right, actually we've got any surplus cash, I want to put that in my pension, get a corporation tax saving, top up the pension, that's fine, that's still going to work for company owners. What this is trying to target is some businesses who've got auto-enrollment pensions have a scheme in place through the pension company which allows them to change the way the employee's contribution is structured, and it effectively then saves them the employer's national insurance on their little 5% contribution, and it also saves the employee their personal national insurance on their 5% contribution. So that's what this is trying to attack. It's a little loophole that a few pension providers are providing, and it's quite good, certainly for the employer, because the employee does save a little bit, but the employer is going to save it across all of it. So the bigger your staff base, the better it is. So that's what this is trying to attack. So thank you, Simon, who was walking past my desk when I was, there's Simon, look, I'm going to the back. Thank you, Simon. He walked past my desk and I was like, that's it. Great. So yeah, it closes the loophole on this. But as you saw on the earlier slide, this only gathers about 1 billion. I know 1 billion is a lot of money to us, but to the government, 1 billion doesn't seem to be that much money. So it doesn't really raise that much. This is just them promoting something that is just closing a loophole in legislation. But it also isn't coming in until April 2029. So for anyone who's got employees, got an auto-enrollment pension scheme, this is the time to go review it, talk to your pension advisor and work out what's happening. And some of you in the room might be thinking, hang on, I want to get involved in a scheme like that and save the national insurance. Well, you've got a couple of years that you can utilise it. So it's all closed. Yeah, so talk to your pension advisor. That's my advice here. And then I want to touch upon the change in taxes for investors. And this is where, this budget was very silly. I was saying to a few people before that we didn't have an announcement about the tax rise. We had, I think it was 18 different taxes were pitch rolled before the budget, where the press were talking about it, and then we got an announcement saying they weren't going to do a tax rise that they hadn't announced. It was very confusing. But what I can see in the budget we finally got, we've got a few bits of shadow from where they tried to just increase all income tax rates by 2%. And then they cancelled it for income tax for working people, but they kept it for what they class as investors. So there's a 2% tax increase for rental profits, there's a 2% tax increase for savings income, and actually the dividends tax increase is part of this 2% as well. In my view, this is national insurance by the back door. Since they started cutting the national insurance rates, I think that is someone in the Treasury, that the civil service, HMRC, are saying, actually, can we get away with national insurance and just have one big tax system? So the reduction in national insurance, they're then putting it onto the main tax rate bands. That's what I think is happening, and I think this is a shadow of where they didn't actually roll it out across the whole system. The biggest factor in this is it doesn't impact income from pensions. What they've done is target every sort of investment apart from the income you get from your pension income. And this also then means that utilising things like ISAs and corporate investment pots and pensions become a lot more useful. I also want to note that where the basic rate band for rental income is now being taxed at 22% from April, this does mean if you've got a mortgage on your residential property that you let out, the income tax that you save on the interest on that mortgage is restricted to the basic rate band. So at the moment, you only get 20% tax relief on the interest. Well, that's also going to align with 22%. So I point this out because sometimes people think, hang on, I don't get any tax relief on my interest on my property, but you do, it's just restricted. Yeah, and also this is going to mean we've got a much more complicated tax system, because this tax year, savings rental and employed and self-employed income, they all come under the same income tax. It's all the same tax regime. This is going to separate them all into their own separate pockets. So when I fold out my tax tables, it's going to have a whole extra leaf to it to list all these separate types of taxes. So it sounds simple in my little fold out tax things, but somewhere in the background there's going to be reams and reams of legislation. And of course, when there's reams and reams of legislation, there's unintended consequences. So we'll find out what they are once we get the legislation. So that is my little précis of the main things of the budget. So as I say, it's very tinkery. So I'll now hand to Emma, who can talk about some less depressing things.
I hope so, anyway. Right, thanks, Josh. So, probably the biggest thing to change in the budget was actually about employee ownership trusts. Has anyone heard of it? No, any heard of employee ownership trusts? No, right. An employee, if you think John Lewis, when you think of the employee ownership trust, all the employees are involved in some way. So they've become a bit of a tax planning popular way to dispose of businesses, particularly in situations where maybe there hasn't been a third party buyer. And effectively for the seller, the business owner, the disposal was actually 100% CG capital gains tax free. So what we've had because of that is it hasn't been used for the philanthropic benefits of actually passing on businesses to employees and, you know, having this wonderful way of passing down wealth. It actually means that HMRC have tried to make it slightly less attractive by halving the relief to 50% overnight. So if I circle back a bit to what employee ownership trust is, so it's the trust owns the company, so no individual has any direct percentage of the company. It's not allocated, it's just the whole group, from whoever's going to run the company now right through to the cleaner. And there's some benefits to the employees. They can receive a certain amount of tax-free dividends every year, and the trust holds the shares in the company, so people kind of come and go throughout the life of the business. So the advantages of an EAT are that obviously people are still able to realise the value built up in their business in a more tax efficient way than necessarily a management buyout. Obviously you've got the leadership succession, because if you've been good at bringing people through the business, then you should have that understanding of how the business operates, and that should be working through the business, and it can come through over time. So the exiting owner, they don't have to exit instantly on day one, they can still work within the business. You've obviously got peace of mind, hopefully that it's in good hands. And I think there's a legacy, you know, a good warm fuzzy feeling that you are passing it down to people that have helped you build the business to what it is. And all the employees are involved in some way. So they're the sort of advantages. So what are the disadvantages? All the employees are involved. So you can imagine it probably feels like sometimes running a business by committee. So you have to have some quite strong leadership in that structure for that to actually work. Otherwise you'll find there's a complete lack of productivity because everyone's trying to decide who makes decisions and what should happen next. The cost to set up, it can be costly to set up. Obviously you're talking about trust, you're talking about having to explain to the staff what's going on, and there's a lot of legals behind the scenes. So you're looking at sort of £25,000 or above. There's normally less uplift on the sale value, because obviously if you're selling to a third party, hopefully you're selling to someone who sees some real advantages with your business and potentially some synergies. Whereas obviously selling to staff is, one, you're probably talking about values that are significantly more than their mortgage, so it sounds a bit scary, doesn't it? But also it's just harder to push those uplifts and those multiples, so you have to be quite considered on your valuation. Unless the trust is happy to get lending, obviously what normally happens is the majority of the proceeds are delayed and are paid out over years of profit. So what happens if that isn't successful? Obviously you've always got that risk that you are handing over your most valuable asset and hoping that it will be able to pay you for the value over the years. And you've got capital gains tax payable on day, sort of at the point of sale. So regardless of if you spread it over 10, 15 years, you have got the CGT to pay up front. So as I said, what was the big change? So went from 100% CGT free, which is why a few people have spoken to me about it, and certainly why it's been recommended by friends. And so that has halved overnight. And what it means is the tax payable on that disposal will now be 12%. The reason it's 12% is capital gains tax is 24%. And you don't use business asset disposal relief. So business asset disposal relief is normally available on the first £1 million, and it reduces the capital gains tax rate. At one point it was 10%. It's risen to 14% this year, ending in April, which is why any solicitors in the room will be busy by the end of March. And from April it goes up to 18%. So it'll be 18% for the first $1 million and then 24% thereafter. So it is still quite a tax efficient way, but I think it's got to be right for the business, would be my advice. But that's been the biggest change. So as I said, there's no cap on disposal. So I thought it'd be good to talk about some of the new, what we would consider new popular structures and why. Obviously, the big changes with inheritance tax and, things like businesses worth over £1 billion falling into the taxable estate, pensions becoming part of the estate, and property and things. We are looking, the things we spend a lot of time looking at and things we've loved for a long time, for anyone that knows us, are limited liability partnerships. So we ourselves are a limited liability partnership. And the reason we are is it's a partnership, but it has formal legal entity reporting. So it does have that segregation you get from a limited company with that limited liability wrapper around the entity. It is transparent for tax purposes in the same way, so you'd be taxed as self-employed tax rates. So unlike a limited company, there's no tax charging on introducing an asset. So we are using them for restructuring property portfolios within families. Profits can be split according to the terms. So this is actually the reason we're structured as an LLP is because it gives us flexibility about our profit share, and that can change every year based on people's responsibilities, maybe their clients they're managing, all sorts of things. And I think it would be fair to say that no 50-50 shareholding business has ever been 50-50 effort, in my experience. Not for the life of the business. You often get a bit of push and pull, and I think for everyone you hope that over the life of your business that will balance out. We also do business separation, so I have seen it go wrong. But I think that's it, and so partnership gives you that flexibility. So how profits and capital split without an agreement equally between members. So we would never recommend setting one of these up without a limited liability partnership agreement, because it gives you the ability to sort of build in whatever terms you like to the agreement. So fixed profit share, you can have a fixed profit share for work done, which is quite often the challenge. People have different roles throughout life of the business. I won't use the word salary, but allocation of sort of hours and responsibilities. Then you have residual profit share that might be in a completely different split, and then you have equity ownership that can be defined differently as well. So typically, Josh and I do a lot of structures like this for sort of family property portfolios, often where we might want to give some profit shares to older children, but we do not want them to be able to make the decision to sell the house out from under you and buy a car. So that's why they're really handy. It allows the passing of wealth down the generation whilst the control maintains with designated partners, which is often sort of mum and dad. So as I said, why would you pick an LLP? If you've got low working capital requirements, so as Josh said, the self-employed benefits, if you haven't got a big working capital requirement and you are looking to draw all of your profits out, the rates of tax that you pay will be less than if you were drawing all your profits out via a limited company. Quite often for sort of new structures, so with limited companies, if you've got two limited companies under the same control, they halve your tax bands. So you get 50,000 at 19% at the moment. So if you've got a little dormant company you set up, or maybe a really small company you're doing £1,000 in trade through, you suddenly lose a chunk of tax relief there. So sometimes new ventures are quite good, or joint ventures. We use it for succession planning for businesses who want to bring in senior members of staff and start awarding them with profit share for the efforts they're retaining. As I said, property planning. the lower tax rates, the flexibility, and for any of our clients that do not like electric cars, there's good tax relief for the gas guzzling vehicles as well. So I thought it was good to put into context why structures like this are becoming more popular. So on top of limited liability partnerships, what else are we seeing? We're seeing holding companies become much more prevalent in the business structure market. Now, obviously, if you've got a traditional company, you've got two people as shareholders, say, often what the common problems with traditional structures that we see are, you've obviously got the restriction of the business asset disposal relief on exit. You've only got £1 million at the lower rate, and then everything else is 24%. And obviously, quite often, if we see businesses selling for more than £1 million, that's probably more money than they need for the rest of their lifetime, because they've done, sort of squirreled away other investments and things along the way, if they've done the right thing. Often we see spare cash in limited companies, and it's a case of what do I do with it? They might have maxed out on pension or don't like pensions. They're not a fan of pensions. Quite often our clients who like property don't like pensions. So it's a case of how do I invest it? Obviously, if you draw it as a dividend, you've now got an even bigger dividend tax rate. And if you're investing money within a trading business, you risk losing trading status. So if more than your 20% of your balance sheet value is actually investment, you lose trading status, which means that actually for capital gains tax, you shoot right to the 24% rate. And also for inheritance tax purposes, you don't get the first £1 million inheritance tax free either. So it is quite significant. And as I said, building generational wealth subject to inheritance tax. So we do see a lot of structures that end up with cash stuck, and I'll be honest, it's not well invested because no one really knows what to do with it. It's sort of there for a rainy day. So with a holding company, what we're seeing is people put holding company underneath. And there's all sorts of structures. I think the traditional thing a lot of people expect is 100% owned by the holding company. Now, depending on what clients want to do, we recommend different types of structures, because actually, upon sale of a trading company, so if you've got a trading company, the holding company is owning 100% of the shares. If you sell the shares of the trading company from the holding company, there's no tax payable. Provided it's a trading company, you've got substantial shareholding exemption. So actually, if you've built this value in your business and you don't need it, you're going to pass it on to the next generation, that can save you 24% tax. But what we often find is we do want a bit of play money. So it might be that some of these structures end up, provided you've got at least 10% owned by the holding company, that percentage would then be tax-free. So for most clients, it's a bit of a balance. But it's useful then because money can flow down from the trading company to the holding company, maintaining the trading company's trading status. Meanwhile, the holding company can then invest in whatever it likes: wine, stocks, shares. We saw all sorts of things, art, Rolexes, apparently in Saints. But the other thing that you can look to do is if you've got children, the children could become shareholders of the holding company with different share rights. The circle is you might want to put trust wrap around it. And again, this is ways to sort of cap wealth. So if you've built a certain value in your business and you're actually now really nervous about inheritance tax because your pension's coming into it and so is your business, there are things we can do to cap wealth. There are things we can do to gift wealth to the next generation whilst controlling it. And the trust element allows us to protect it from divorce in a lot of cases. So this is what we're seeing now with the rise in capital gains tax. I think you have to plan early for big business exits, and if you've got a growing business with employees and you're generating more cash than you need to spend, you should be looking at a slightly smarter, more sophisticated structure to allow you to benefit from all your hard work. So I'm going to pass over to Josh for making this exhibition. Hopefully that was a bit more exciting than the budget.
Here I come to depress you all again. So I want to talk a little bit about something that they didn't talk about in the budget, but is coming in. And this is alongside some things that were in the budget, which is that generally we're seeing some higher administrative costs. They're a bit of stealth tax. coming into the budget. So Companies House, they're looking to double the filing fees from February next year, I think it is, having already just increased them significantly in 2024. Penalties for corporation tax late filing have also doubled. But the thing that I want to talk about is making tax digital, which isn't a penalty, it isn't a charge, but it is going to cost landlords and self-employed people in the form of administration. So I've been talking about making tax digital for nearly 12 years and feeling like an absolute fraud, because every time I talk about making tax digital, oh, this is coming in, be warned. They then go, oh, we're not ready to do it yet, we'll delay it. And then all of a sudden I'm going, yeah, okay, they're not doing it now. But apparently this time it's happening. The reason why I know it's happening is because the podcasts I listen to, because I listen to really fun podcasts, they've sent HMRC representatives to go and talk on the podcasts, and they never send HMRC representatives out. And so they're saying, yeah, it's coming in. This is coming in from April next year, when landlords and self-employed people, it doesn't include partnerships and LLPs, funny enough, but it does include self-employed people and landlords, are going to have to report their income and expenses quarterly to HMRC. It's going to be phased as how it comes in. So from April 26, if you've got a combined turnover, so it's not profit, turnover, from your self-employment and rental properties of £50,000, if it's 50 or 1,000 or more, you're going to have to start doing these quarterly submissions. Then from April 27, that threshold is going to reduce to 30,000. So again, that's the combined of all properties and self-employments. And then from April 28, it's going down to 20,000. So how are you going to do this? Most of the time, you're going to need some software to do it, because ultimately this is a digital revolution in the tax system. So they're asking everyone to report this income and expenditure through software. What they also are saying is, although you've got 4 mini returns to do, you've still got to do a year-end return, so a 5th return still required. So obviously this is going to increase the admin cost and time for taxpayers. Because people, if you've got a rental property, you want it to just tick away in the background, it's passive income, and all of a sudden you've got to actively do something every quarter to record it. Now, HMRC in these podcasts have said, it's going to be a little bit dicey as we go into this, and we're expecting there to be some teething issues, and we'll have to iron them out as we go. So that's a vote of confidence from HMRC in this system. But, effectively they're going to say in the first year they're not going to impose any penalties. Well, thanks for that. So yeah, it's going to be a bit shaky, I think, for the first year. And they are expecting issues to arise on the new system. I think the real world consequences of this is going to be that we'll probably see a rise in tax investigations, because if the 4 quarterly submissions don't add up to the submission that the accountants make at the year end, that raises the question of what have they changed at the year end? It either means the accountants have worked out some things to put through that the revenue might want to know what they are, or it might mean the records were so pants that they want to come and have a look. It's like, it's that bad, we must be able to find some more tax to fish out of here. There's also been a lot of talk about this turning into a quarterly tax system, so that self-employed people and landlords can pay their tax on a quarterly basis based on these numbers. I think there are lots of flaws to that system, and it's not something they're currently pitching, because if they think it's going to go wrong, I don't think they want to pay everyone their money back. But it's on the cards, I would say. But the actual goal as to why they're doing this is because if you think back to that pie chart I showed you, you've got significant amounts of income for the government is driven from income tax. Now that income tax bit of the pie includes rental and self-employment. And at the moment, the government have no idea how much money they're going to be able to play with come April until the 31st of January, when everyone's finished their tax returns. So this system's trying to get the government's computer to predict how much tax is going to be generated in a year, to know how much they've got to spend the next year. When you think, it does make some sense that the government should be able to plan ahead their spend. So I do understand that. It's just that it's going to be an absolute pain. So that's the reality of it. Now, the advice I'm giving to clients, the first thing you should do is, if you've got rental properties or self-employed business, have a separate bank account for your properties and a separate bank account for your self-employment. Don't muddy the water in a bank account between your personal expenditure and that of your rental and your business. First of all, you shouldn't do that anyway, because if you get a tax inquiry into your self-employment, you can just throw your bank statements at HMRC for the self-employment and they don't have to see your personal ones. So that's always good advice anyway. But the other reason is the software that will be used for this will read your bank account to allow you to effectively automate allocation of income and expenditure. So having a separate bank account, keeping it clean, is going to make that admin bit all that much more easy. There are going to be complications with it, I'm sure, because we were already talking yesterday. How do we deal with you get your money in net of the agent's fees? So how do we put that into bookkeeping? Now, I'm sure AI will come to the rescue. So we're currently looking at the software providers. Anyone who already uses Xero for their business, Xero is going to be, I think they already have a package that works with Making Tax Digital, because there's a test case going on at the moment. But Xero is not going to be the cheapest provider in the market. And if you've got a rental property, if you've got to pay £6 a month for software to do your filing of the return for Making Tax Digital, that's going to erode the margins you make on your rental property. So this is the two things that you need to think about now: bank account and start thinking about the software. In the coming months, we've already started testing different bits of software so that we can give an informed view on which bits of software are going to be cost effective. So balancing the cost of it per month and how easy it is to use, because I think ultimately most people, although you don't want to do this, you also don't want to have to pay someone else to do this. So we're going to try and help in any way in which we can. So watch this space for more boring Making Tax Digital news. So to summarise the budget, what we'll be doing next year, we're going to probably see a continued drive in IHT planning. This year we've seen more IHT questions come to us than I think any year previously, and I'm sure that will continue. So we'll still be talking about that. I think there's going to be a lot of property planning to do, because one of the things, if you move all your property into a partnership, you suddenly don't need to do an MTD return, just FYI. We're going to be obviously talking about it as digital, and we've got on the cards that it's very popular when we've done it before to have a guest speaker from the Bank of England with us, so we're looking to do that next year as well. I think we've got it vaguely penciled in, so that will be coming soon, because they're always more interesting than me. So, in a nutshell, the budget could have been better, but it could have been worse. And our advice is always, we can't do anything about the budget as an individual. All we can do is control the things that we've got control of. And that's where our advice, we try and help people take control of the things they can control. I'd like to thank all of the A4G team, even the ones who are not here, because it's been a big year for A4G, a lot of hard work. So thank you to our staff, thank you to all our clients for your ongoing support, and also all of the friends of the firm here who've been along the ride this year with us. Thank you very much. And then the final, also marketing team, thank you very much. This is very professional. I feel a little bit of imposter syndrome at how wonderful this looks. Thank you very much for you. Final thing, if you're all depressed by the budget, there's some more drink over there. I'll join you at the bar. So thank you very much.